How to invest in IPO. Investing in an initial public offering, or IPO, can be an exciting avenue for turning financial goals into reality. As a finance enthusiast, you've probably seen the buzz around IPOs and wondered whether they're worth the hype or how to access them effectively. Well, you're in the right place. This comprehensive guide breaks down everything you need to know about IPOs, from what they are to how to evaluate investment opportunities strategically and confidently. Let's dive in. Let's start with the basics. An IPO, or initial public offering, marks the moment when a privately held company begins offering shares to the general public for the first time on a stock exchange. Think of it as a company going public. The ultimate goal is to raise capital for business expansion, debt repayment, or other operational improvements. For investors, IPOs present a unique chance to invest in a company at the ground floor. Getting in early can sometimes mean high growth potential, but, as with all investments, it's not without its risks. Understanding what IPOs represent and why companies execute them offers critical context for making informed choices. Companies turn to IPOs for various strategic reasons. Primarily, they do it to raise substantial funds. By selling shares to the public, they generate capital to fuel growth, scale operations, or finance large projects like technological advancement or geographic expansion. Going public also boosts a company's visibility and prestige. It can attract talent, instill market confidence, and create liquidity for early investors or employees who own equity. However, being publicly traded comes with scrutiny, transparency requirements, and market pressure, which is why companies think strategically before taking this step. Before diving into investment strategies, let's look at how the IPO process works. When a company decides to go public, it partners with investment banks, known as underwriters, to prepare for the offering. These underwriters help determine the IPO's pricing, market timing, and allocation of shares to institutional and retail investors. The key document in this process is the prospectus, which outlines the company's business, growth strategy, financial health, and associated risks. Once the IPO is priced and approved by regulators, the shares are listed for trading on a stock exchange. For you as an investor, understanding how this process works ensures you'll know exactly what you're getting into before committing your money. Now that you understand the basics, how do you evaluate whether an IPO is a good investment? Let's break it into key steps. The prospectus is the most critical document for IPO analysis. It's essentially a company's roadmap for success and risk disclosure. Focus on elements like the business model. How does the company make money? What sets it apart from competitors? Growth potential. What markets or industries does the company serve, and are they growing? Risk factors. Are there significant challenges or dependencies that could hinder success? Look closely at the company's revenue growth, profitability, and debt levels. A high-growth company may not yet be profitable, but make sure their strategy for achieving profitability aligns with their financial disclosures. Strong leadership can make or break a company. Look at the executive team's experience, past successes, and whether they've delivered value to shareholders in previous roles. An IPO in a growing industry with manageable competition often has higher potential. Analyze how the company fits into the industry landscape and whether it offers a unique advantage, often referred to as a moat. One mistake many IPO investors make is diving in without regard to valuation. Ask yourself, is the company's offering price justified based on its fundamentals? Overvaluation can lead to disappointing stock performance after the IPO hype fades. While IPOs can be exciting, they require careful consideration of inherent risks. Here are some to watch out for. IPOs are often more volatile than established stocks. Once a stock begins trading publicly, its price can swing dramatically based on investor demand, market sentiment, or new information. Early investors, employees, and insiders are often restricted from selling their shares immediately after the IPO. The end of this lockup period can result in increased selling pressure, potentially driving down the stock price. As a new entrant to the public market, the company may lack the historical financial data or performance metrics you'd normally use to benchmark other investments. Some IPOs are surrounded by significant hype, which can inflate expectations and valuations. Always separate market noise from genuine opportunity. To navigate both the opportunities and risks, having a strategy is essential. Here's how to build one aligned with your goals. Assess whether investing in IPOs fits your broader investment objectives. Are you seeking long-term growth, short-term profit, or portfolio diversification? Your intentions will dictate where IPOs belong in your plan. IPOs can be unpredictable, with potential for both gains and losses. Make sure you're comfortable with the possibility of short-term volatility before committing significant funds. It's tempting to go all in on a hot IPO, but this overly concentrated strategy can backfire. IPOs should remain a small portion of a well-diversified portfolio to manage risk effectively. Instead of buying a large number of IPO shares up front, consider phased investing. Monitor the stock's post-IPO performance and buy additional shares only if it aligns with your expectations for growth. If you're uncertain about IPO investing or need tailored advice, don't hesitate to consult a financial advisor. Professional guidance can help you navigate complexities and strengthen your approach. The biggest question for retail investors is often how to access IPOs in the first place. Here's a step-by-step breakdown. Many brokerage platforms, such as Fidelity, Robinhood, and TD Ameritrade, provide IPO access for retail investors. Ensure your account is with a broker that supports IPO allocations. Some brokerages enforce eligibility standards, such as a minimum account balance or trading activity, to participate in IPOs. Check the requirements early to avoid last-minute issues. Many brokers allow you to indicate interest in specific IPOs through their platforms. This process may involve pre-ordering shares at the offering price. In recent years, technology has democratized IPO access through services like EquityZen and Forge Global, allowing investors to buy shares in private companies pre-IPO. If you're unable to secure shares directly during the IPO offering, you can still buy the stock after it starts trading. However, evaluate whether the higher price post-listing aligns with your investment thesis. Wrapping up with actionable advice, here are key tips for success when investing in IPOs. Do your research. Never invest blindly. Study the prospectus, financials, and market dynamics. Avoid the hype. Separate headline excitement from real growth potential. Be patient. Not all IPOs deliver immediate returns. Long-term perspectives often yield better results. Monitor the market. Stay informed about market conditions and news that may impact IPO listings. Start small. Begin with modest investments until you gain more experience and confidence in IPO investing. Investing in IPOs can be an exhilarating and rewarding experience for those who approach it with a strategic mindset. By researching thoroughly, understanding the risks, and crafting a thoughtful investment plan, you can position yourself to capitalize on the growth potential these opportunities offer. Remember, IPO investing is only one piece of the puzzle in growing your financial wealth. Keep diversifying, stay informed, and seek advice when needed. Ready to take the next step? Watch our additional resources for more insights into smart investing, and don't forget to hit subscribe for updates on new educational content. Let's make your financial journey IPO ready.